Who knew that one day we would be living in a world where just a tweet can change the financial industry in a day? Today, just a casual remark on social media can spread in minutes and can make or break a business and undermine public confidence. Stock market manipulation has always been around, and new technology and platforms have made it easier to gain knowledge about a company and spread that knowledge in a matter of minutes. Manipulating the stock market is actually fairly easy, and it's done more often than you think. Big business has even figured out how to achieve it in a perfectly legal way. In this presentation, I'm going to give you info on some of the types of market manipulation and what you should look for. As an amateur investor myself, I have always been intrigued with the stock market and the ins and outs of investing. I want to share information I have picked up with the beginner investors to hopefully prevent them from getting scammed and making a few mistakes I've made. Your chances of being successful in the stock market all depend on your knowledge of the market and knowing ways you and the market can be manipulated. I want to give you some information on the variety manipulation forms, and I want to show you how easy manipulation is for big businesses. I want to tell you why you need to look out for penny stocks and why you might want to avoid them at all. First, there's many forms of market manipulation you should look out for. Market manipulation is defined as a deliberate attempt to interfere with the stock market as a way to gain profit by deceiving investors. Manipulation occurs when there is a distortion of prices to create false demand. A group of traders can create activity or rumors to drive up the price of a stock. This is sometimes referred to as ramping. Individuals or companies can also make stock trades and decisions based on inside info not available to the public. A company or individual may have confidential info about a company and take advantage of it to make a profit or avoid a loss by buying or selling according to the event. This is known as insider trading. A similar practice is called cornering the market. Traders purchase enough of a particular stock, commodity, or other asset to gain control of the supply and set the price. Sometimes public shares in a stock are limited, and the public is not given a chance to purchase shares in a profitable company, which leaves them at a disadvantage. Churning happens when a trader places both buy and sell orders on a stock at the same price. The increase in activity is intended to attract other investors and increase the price. Whenever a lot of activity is going on, it tends to gain attention. One of the most common ways to manipulate the market is through a spread of rumors with false or misleading info about a company. This can cause investors to sell, and by the end of the day, $1 million company could be bankrupt. Once you're aware of the various market manipulation tactics that are used, it's easier to avoid them and save yourself some headaches and a little bit of cash. Another thing to watch out for is manipulation of the market by big business who make it look legal. Institutional investors can easily move stock prices to their advantage. They can even achieve it in a perfectly legal way. The problem we have as individuals is that we don't have access to the techniques of big business, and we often end up on the losing end. This is where your knowledge and a little research could save you from losing money. The process by individual investors is pretty basic, but it works for them. It's relatively simple to accomplish. It first involves picking stock it owns and begins to sell. As the investors dump the stock onto the market, the price will begin to nosedive. As the prices begin to plummet, a lot of other investors start to panic and then sell their stock as well. As a result of this, the price continues to nosedive. As the prices hit rock bottom, the institutional investors jump back in and aggressively buy back the same stock, which then causes the price to rise again. Other investors notice the price rising and they begin to buy back, which makes it rise even more. The cycle begins again when the price is sufficiently high. And what happens is the institutional investor, through its purchasing power, has the ability to drive prices down and then buy back into the stock at a low price. It rides that price up as others join the rally, and it pockets a hefty profit. This is called the slingshot effect, and yes, it's legal. The lesson for us as amateur investors is never count on short-term gains in a stock, because those could evaporate very quickly for what appears to be no apparent reason. If the stock is used in a manipulation scheme, a good tip in that case is just go ahead and sell your stock. This will help you to avoid losses if the prices continue to fall. Now that we've seen how easily institutional investors use their purchase power to turn the market, we need to look at penny stock, which is the easiest way to manipulate an artist, or to manipulate an investment. This is the one you should look out for, and the one type of stock that was highlighted in the movie The Wolf of Wall Street. This last tip is probably the most important because penny stocks are the least expensive stock to obtain by the average investor, who's usually ill-informed and trusting. Because penny stocks have a listing on a stock market, investors assume that they're legitimate and high-quality companies. But just because penny stocks are plentiful and listed, they often come from companies that are close to bankruptcy or from legitimate companies whose operations have ceased to exist. Penny stocks become common targets for unethical behavior because they're priced low. Some even trade for fractions of pennies. If a promoter can change a stock from 1/10 to 2/10, they've theoretically doubled their money. Shady characters and scam artists don't need permission of management or anyone else to run a promotion of any public traded company. Just like an average investor, they can trade any shares on any market without the executive of the company having any knowledge whatsoever. These not so honest characters can use emails, press releases, or even comments on a message board to get false information to investors to turn the stock in their favor. Promoters often use the pump and dump scheme to buy inexpensive shares from non-operational companies, talk up the shares, and then sell while it's high. The Securities and Exchange Commission take action against the worst of these from time to time, but because they're so underfunded, they have a hard time combating most of these penny stock promotions. These are just some of the manipulation tactics an amateur investor needs to watch out for when trying to make a profit in the stock market. Just remember that stock market manipulation is alive and well in our technology and society. We as amateur investors have a better chance of making profit if we have some knowledge of the way the stock market can be manipulated. We need to know how institutional investors can manipulate the market while making it look legal, and how we can prepare to protect ourselves from this cycle of manipulation. Most importantly though, it is to know what to look for when investing in penny stock. And this knowledge of common form of manipulation and institutional manipulation in penny stocks are all key to financing a successful investment. I hope I was able to give you a little insider knowledge on all these common and manipulative practices. Happy investing.